Hi guys, and welcome to our podcast. Today we're going to discuss the keys to survival in a bear market. A bear market occurs when the prices of investment instruments generally decline over an extended period. The term bear market is most commonly used in stock trading, but can also refer to a negative environment for other securities like bonds or commodities. The period of time when prices generally decline is referred to as the duration. Most bear market durations lasted more than 1 year, but did not extend more than 2 years. Available historical data reveals that bear market duration ranged anywhere from a brief 3 months to a long 3-year spell. As a smart investor, how would you know if a bear market had started? If you wait for the news to say it's been declared a bear, the market may already be down 20%. By this time, it might be a little late. How do we know when a bear market has started? A good investor must be able to sense when a bear market is starting. The signs to look for can include low earnings growth, rising interest rates, high market valuations, and geopolitical events. These things appear to be already present now. One must also be able to answer these important questions. What are the best mutual funds for a bear market? Are there certain types of stocks or bonds that flourish in a bear market? When should one prepare for a correction of the prices? What are the indicators that another bear market is coming? You must also know your own status as an investor. What were you before it started? What are you now? Here are 8 keys to survive a bear market. Some of them will fit your investment style better than others. First, use a portfolio hedge. Portfolio hedging is a technique designed to specifically protect you in a bear market situation. The security hedges will normally move in opposite direction of major indices. Portfolio hedges usually include financial derivatives, options and futures, negatively correlated ETFs, index options, and short selling. Some of them may be effective for you or not. It all depends on your level of skill, knowledge, and risk tolerance. If done properly, hedging will offset some or even all of the losses in your portfolio. Inversely, losses can be substantial if the market rallies because your hedges will move further in the opposite directions. Short selling may expose you to undeterminable risks. At Cornerstone, we don't short. We use other tools and strategies to hedge portfolios. The second key for survival is maintaining investment balance using tactical asset allocation. Plan how you will structure your portfolio before you actually invest your funds in a bear market. This is a tactical part of your portfolio construction. As you may know, it's not wise to attempt timing the market by diving in and out of stocks, bonds, or mutual funds. A much smarter move would be to make small and deliberate adjustments in the asset allocation of your portfolio. Asset allocation is the greatest catalyst of your total portfolio performance, especially over extended periods. An investor who is just average in terms of investment selection but good at asset allocation might have good returns. Conversely, an investor with a good investment selection but a poor asset allocation might have a worse performance. Let's suppose that the indicators of a bear market are beginning to manifest. High PE ratios, interests. By all indications, a new bear market is just around the corner. You can already make a move to reduce your exposure to riskier stock funds and your overall stock portfolio. Begin building your bond fund and money market fund positions. Let's assume that your target or normal allocation is 65% stock funds, 30% bond funds, and 5% cash and money market funds. Once you see all the major signs of a bear market becoming present, you may want to adjust your allocation. You can mitigate risk by reallocating 50% to stocks, 30% to bonds, and 20% to cash funds. See the best plan Bs to the money market. The next step would just simply be selecting the mutual fund types that can help reduce your investment risks. Another important key to survival is to set an effective stop-loss order. To protect your portfolio from further decline, a stop-loss order may be the solution. It's an order to your broker to sell your stock once it falls to a certain level below the current price. When the stock price dips to that designated stop price, the broker will automatically execute the order. You can hang on to your portfolio and just wait until the stock hits the stop price levels. You can also raise the stops as the price of securities goes up. This way, you may even realize modest gains instead of a loss. The downside is there's really no assurance that your stocks will be sold at the indicated price. Once the stock prices hit the stop level, it already becomes a market order. If it is traded at the market and the price drops below the stop level, you will likely get a lower price. You can use more technical indicators such as support and resistance trend lines, candlestick chart, and volume in order to get the right decisions. Monitoring the PE ratios on the S&P 500 index is another great key for survival. Technically, the PE ratio tells you the amount of money you need to invest for each cent of the income of a particular stock. As such, it is widely used by traders, investors, and stock selection. Although it may not accurately predict short-term market fluctuations, it can give insights into the value and direction of equity prices. The PE of the S&P 500 index is like a barometer to determine if stocks are overbought or oversold. Historically, the average PE ratio for stocks since the 1870s has been about 15.66. If you take the average price of the big cap stocks in the index and divide that by the respective mean earnings, you will get a corresponding PE. This resulting ratio is called the market. If this PE is significantly higher than 15.66, it would probably go down in the future. If it is lower than 15.66, you can expect it to rise. A much simpler way to get the PE ratio of the S&P 500 index is by a Google search or accessing an online quote for any of the best S&P 500 index funds. The fifth key is to diversify your portfolio by using traditional defensive investments. In the bear market that followed after the dot-com bubble, the information technology sector absorbed most of the brunt. This was because IT companies were then trading at astronomical values. Similarly, in the last bear market that followed the financial crisis, it was the turn of the financial sector. The financial sector was sent reeling on the ropes because of the subprime lending. A few sectors are considered defensives because their businesses are non-cyclical and not easily affected by larger economic cycles. Examples are utilities, healthcare, FMCGs, and pharmaceuticals. Some investors park their money in them with the belief that it will be safe during a fall of a bear market. There may be some merit in that line of thought. During the bear market period from March 24, 2000 to October 9, 2002, this safe haven strategy proved its mettle. When the whole market was tanking, consumer staples rallied to 24.23%, while healthcare only registered a marginal 6.92% fall. But during the last bear market from October 9, 2007 to March 9, 2009, there was no escaping the fire. Not a single type of portfolio was spared. Although consumer staples fell far less than their counterparts in the financial or industrial sector, the decline was severe. It would have wiped out a considerable portion of your portfolio should you have parked your money there. In such case, holding on to cold cash would have been better than putting your money in defensive stocks. This is why the whole diversified portfolio strategy is never ironclad. Another key is to ask yourself, what is your strategy? Cash out totally or partially? You may opt to sell off all or only the most overvalued securities in your portfolio. This is a very drastic move, one that needs careful analysis and a good strategy. Your momentary exit may spare you of the fear and worry of losing more money. The market may hit rock bottom without affecting you at all. But when do you go back in? Good timing is everything. A good rally may be tempting, but it may be at the wrong time. Stick to your fundamentals and see why and when you should jump in again. Don't be afraid to go against the flow. Securities that went down the most are good buys only if there's a guarantee that they will recover first or quickly enough. Since there's no surefire way to tell, one has to have a strong determination to use this method. You could probably nab some stocks that are selling for less than half of their previous values. However, you should be ready to accept the reality that they might still go down after you buy them. The real discipline is in looking for the stocks that eventually recover well over the long term. The last key to survival you should consider is not doing anything at all. This one is simple. Stay put and just wait for the market to recover. Hopefully by then, your investments will still be intact and poised to grow. A word of caution though. Markets can take years to fully recover. The waiting game will test your patience, so see if you're up. See common mistakes made by investors. Now that the whole bear market scenario has become clearer, what do you need to do? You're in luck because my strategy works for both bull and bear markets. There's no more need to diversify your portfolio or do some advanced number crunching analysis. A bear market is not to be taken lightly. On the other hand, an investor equipped with the right strategies does not have to worry about it. Use any or a combination of the first 7 strategies to survive a bear market. Who knows? You may even profit from it. That's it for now. On our website, you can find more posts as well as investment calculators and other financial tools. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. We would love to know your survival keys, so feel free to share them in the comments below.